G'day guys, welcome back to the Devon Too Good Investing channel. Today in this video we're going to go into what is a wash sale and how investors in the stock market can take advantage of the wash sale rule so they can reduce their tax bill. So you probably noticed recently that there has been a fair bit of downward selling pressure in the stock market, and around the end of the tax year, at least in the US, many investors choose to sell stocks that are performing really bad to offset capital gains in stocks that have performed well. So simply put, a wash sale is a transaction in which an investor seeks to maximize tax benefits by selling a losing security at the end of a calendar year so they can then claim a capital loss on taxes that year. Then after doing that, the investor will wait a certain period of time. In the US, it's 30 days. In Australia, there is actually no predetermined time that you have to wait. As long as you don't make it obvious, it's okay. But then they'll repurchase that stock again after a certain time period. Here just reiterates what I was just saying. Investors who sell a security at a loss cannot purchase shares of the same security or one that is identical to it within 30 days before or after the sale of the security. So to take advantage of a wash sale, you must follow these 3 steps. First, when investors notice they are in a losing position at the end of a tax year, they close that position at or near the end of the year. So what that means is, let's say you're down heavily on a stock, let's say you're down 30%. You might close that position off and take a permanent capital loss. Second, the sale allows them to take a loss that can legally claim on their tax return as a reduction of their earnings for that year. In this way, they pay a smaller amount of tax. So once you sell that stock at a loss, that loss can then be written off against taxes. So let's say you've sold another stock at a profit and you got to pay capital gains. Well, that loss from the second stock will cancel out some of the gain. And then third, after the new year begins, the investor will look to purchase the security at or below the price they sold previously. So once they wait that 30 days or whatever the period is that you have to wait to legally complete the wash sale, the investor will then buy back into the stock that they sold at a loss and hold it from there. There is some sort of disadvantages to doing this. Let's say you sell out of a stock and then in that month that you have to wait because of the wash sale rule, well, what happens if that stock then goes crazy? Then you're not going to be able to buy in at the same price as what it was 30 days ago. However, if it stays flat, obviously you're taking a risk because it could even go down potentially. Well, then this would pay off for you because you're going to be able to re-enter that same position at or below that price that you sold it at, and then save some money on taxes. So if we have a look at sort of an example of the numbers, so let's assume an investor has a $15,000 capital gain from the sale of ABC stock. He falls into the highest tax bracket, so we have to pay 20% capital gains tax or $3,000 to the government. So let's say he sells XYZ security for a loss of $7,000. His net capital gain for tax purposes will be that $15,000 capital gain minus the $7,000 capital loss, which means in total he's made $8,000. So this means that he only has to pay 20% of that $8,000, which is $1,600 in capital gains tax. So you can see that it has greatly reduced his tax bill. So pretty much for me, the way you're going to sum this up is it worth the risk in selling that stock that you're down in, knowing that you have to wait 30 days to buy back in and not knowing what could happen to that stock during those 30 days? Me as a long-term investor, I am cognizant of this, but it isn't really a big factor in my investing decisions because, if I see a stock sort of fall that I'm really confident in, I'm not going to necessarily want to sell it. I'm probably going to be more inclined to add more to that position. But, if things do fall into place, for example, and you do see this opportunity to save big on tax, well, maybe it's worth it. But anyway, guys, that's what I've got for this video. Make sure you like and subscribe, and I'll see you in the next one.